So next, I would like to discuss the very last adjusted entry, which deals with unearned revenues. Okay? And before I go into trying to explain what an unearned revenue is, I want to set the tone for your understanding. I want you to realize that in an arm's length transaction, an unearned revenue is the exact opposite of a prepaid expense. Remember when we talked about prepaid expenses? You can rewatch the video, but you know prepaid expenses is when you pay on an expense in advance. Okay? What I'm trying to get you to understand is that an unearned revenue is the exact opposite of a prepaid expense. Okay? So let's look at the word unearned revenue. Unearned revenue is obviously a revenue that has been what? Unearned, right? It hasn't been earned. And so if you think about it, how do you earn revenues? You earn revenues by doing what? One or two things, providing a service or selling a product. But if you have a revenue that is unearned, did you provide the service or did you sell a product? No, you didn't. So this is a revenue that is unearned, which means that essentially, if you haven't provided the service or sold a product, you haven't actually had a revenue to exist, right? So when you think about it, it can't be a revenue because you didn't provide the service or sell a product. That's the only way that you create revenues. So essentially, is an unearned revenue a true revenue account? No, it's not, right? And so what happens to create an unearned revenue is you have to receive cash in advance for a service to be provided in the future. So an unearned revenue is an account that is created whenever you receive cash in advance for a revenue to be performed. And that makes sense because if you really think about it, it's the exact opposite of the what? Prepaid. If you don't see it, let's take a look at it. Remember that last example we did earlier with the prepaid that talked about the rent? Yeah, and we took care of that systematically. Well, watch this. Let's say that it's May 1st. And suppose that we received $12,000 for 12 months rent in advance. May 1st, suppose that we received $12,000 for 12 months rent in advance. This particular transaction is almost identical to the first one that we did. Let's look at the key words. Rent in advance, received. That's the difference. Last one was suppose that we paid $12,000 for 12 months rent in advance. We were actually paying the landlord. We were the tenants. Now, this example, we are actually what? The landlord. We're on the other side of the gun. We actually received the $12,000 in advance. So, we don't have a revenue yet because we haven't provided the service. That's why unearned revenues aren't revenues. But think about it. We haven't provided a service. We have $12,000 in our hands. But we still what? Owe. We still owe what? The service. So the fact that we still owe, keyword, leads us to believe that an unearned revenue is not a revenue, but it's actually a what? Liability. It's a liability. Unearned revenues are liabilities. Okay? So we have to have an initial entry on May 1st. So what's our initial entry? Well, we just said that we created a liability because somebody gave us $12,000 for a service that we haven't provided yet. Okay? So what are we going to debit? Well, what did we receive? $12,000 cash. Cash is an asset. Assets increase in the business when you receive it. And so how do you record that? You debit it. So the initial entry will always consider a debit to cash because that's how you create an unearned by receiving cash. And you will always credit the unearned, which is actually a what? Liability. How do you credit liabilities, or why do you credit liabilities? To increase them. So you're going to credit unearned rent revenue for $12,000. And of course, we're going to post this. So we have unearned rent revenue, and we have cash. Cash we're not really worried about right now for $12,000. Right? And so that was on May 1st. So made an error. Excuse me. That should be a credit, right? Hopefully somebody was yelling at me just now watching the video. That should be a credit. And so now we're going to move forward to the end of the period, December 31st. December 31st is where you have to adjust the end of the period. And obviously, based on that initial transaction, we have to adjust one of these accounts. Which one are we going to adjust? Rule of thumb, you never adjust cash at the end of the period. So the only thing left is the liability, the unearned rent revenue. We have to adjust that. Why? Because time has passed. And as the landlord, what actually has been going on since that time has passed? That tenant has been staying in there. And you have been providing what? Rent. You're a landlord, so you provided a service. You've been providing rent. And so time has passed causing you to provide a service, which means that that particular liability that you created early on May should now do what? Go down. It should now go down, but it's going down because the actual service is going what? Up. The service is performing. So every month you provide the service, the liability goes down and the service goes up. And anytime that you provide a service, you have to record what? Revenue. So our adjusted entry tells us that we need to adjust this liability. So we're going to debit rent revenue and unearned rent revenue. We're going to debit unearned rent revenue. And we're going to credit rent revenue. Now remember, there's a difference, guys, between unearned rent revenue and rent revenue. What kind of account is rent revenue? It's a revenue account, obviously. However, what kind of account is unearned rent revenue? A liability. So, we have the right journal entries now, but we have to first calculate the amount of time that's passed. Again, we already know it's 8 months. So, we're going to take the 12,000, multiply it times 8 over 12, and that's going to get us the 8,000 that we're looking for. So now we have $8,000 that has decreased our unearned rent revenue, our liability, because we have provided the service. So we no longer owe $8,000 or 8 months of rent anymore. So we've decreased our unearned rent revenue. And so now our liability should reflect only the true amount that we have left. And how much do we have left? 4 months of rent left, which equals $4,000, $1,000 per month. If we fail to adjust this account, what would happen on our financial statements? Our liabilities would be what? $12,000, which means that they would be overstated. They would be higher than what they should be. So this is the important aspect of why you have to adjust. So your account balances will be correct before you go to the financial statements. And of course, we've now created a rent revenue, a true revenue, for 8 months. Very straightforward. Well, it can be. I'm pretty certain that you guys need to watch both of these together. I would suggest watching your prepaid expenses and then rewatching your unearned revenue together so you can see the connection and understand why these accounts aren't affected. Why these accounts are affected and why, if you did not adjust them, what kind of effect would it have on the financial statements. Okay?